Before we get started, I want to remind everyone that the information in this presentation is not to be or construed as investment advice. The information presented are subject to change without notice, and while we have made every reasonable effort to ensure that the content is reliable and accurate, we have not independently verified the content and are not responsible for errors therein. Please consult a professional advisor before putting a loonie in any of these financial markets. Hi everyone, my name is Richard Diaz and welcome back to the IceCap Canadian Market Wrap. Over the last few months, we've been warning that Canadian inflation might head higher. We discussed how the GST holiday gimmick would fade out, how producer prices had the potential to lift inflation back above the BOC's target range, and we argued that this inflation rebound will complicate things for the BOC, and for the most part, that is how it's played out. This week, however, we are confronted with a reversal of that trend, and we're going to investigate what, if anything, that means for our broader view on inflation and the implications for the BOC and short-term rates. Let's get stuck in. Canadian headline inflation rose 1.8% in April, which was a bit more than the consensus estimates of 1.6%, but down from 2.3% in March. On the surface, this is a good print. Headline is back below 2%. However, the devil is in the details. According to Statistics Canada, the slowdown in April was driven by lower energy prices. And we can see that quite clearly with a look at the major inflation subcomponents. Energy prices, down nearly 8% on the month, stand out. And the impact of lower energy prices feed through to transportation costs and to goods more generally, which are also at the bottom of the list. Flipping over to the release itself, we can see that the decline was mainly due to the cutting of the consumer carbon tax. However, I'll remind the viewer that the tax is still on the books and could rise tomorrow should King Carney decree it. But for now, it's set at 0%. Crude oil prices also fell. As a reminder, oil is set on the global level, and worries about growth and increasing OPEC supply contributed to the decline in crude prices, which also naturally feed into lower gasoline prices. However, Stats Canada was quite clear in its assessment. Cutting the carbon tax is the story here. What's cool about the release is that the good people of Stats Canada will often prepare a section that dives into the main story of the month, doing much of the work for me. And in chart 3, you can see the dramatic impact on energy prices over the last month. These carve-outs are important for us when assessing the underlying trend in inflation and testing our view that it will indeed head higher over the next few months, complicating life for the BOC. A look at core X energy, which rose 2.8%, highlights the underlying move higher. One data point does not make a trend, but it looks like the rebound we have talked about is consolidating. The move higher is corroborated by less fickle measures of inflation, the BOC's 3 preferred measure of core inflation. What is significant, other than the direction, is that 2 of the measures, median and trim, rose more than expected and now sit above the target range of 2% plus or minus 1%. And what we are noticing is a trend higher. Regular viewers will recognize this chart, and it's at the core of why we continue to think the rise in inflation is to be expected. One can never fully trust a model, but the IceCap inflation model suggests that the worst is yet to come. Higher producer prices and raw material prices are lifting core inflation. And note, this was happening before the tariffs. Rising inflation should give the BOC pause, but we can't help but feel that given the rise in unemployment and weak economic growth more generally, as well as the uncertainty over tariffs, the BOC might cut rates next month. This all but assures that real rates will be negative again. This means that inflation will be above short-term rates. And this means that in theory, in real terms, you actually get paid to borrow money. This drives us crazy and proves that the BOC has learned nothing from the mistakes of the last 15 years and is happy to screw over savers and the working class to prop up asset holders or the real estate market with free money. We'll touch on this again when we discuss inequality in Canada in an upcoming episode. So here's where and why we could be wrong. And for us, the risk to our view on inflation is dominated by the real estate market. The shelter component is in free fall. It is made up of owner accommodation, rent, and household operating costs, all of which fell last month. This means that the largest single line item in the CPI basket, which accounts for 38% of core, is falling fast, and its contributions are at the lowest they've been in 3+ years. All right, that's a wrap on this week's episode. Please like, subscribe, and follow for more. As always, we manage money for families all across Canada and the world, so please feel free to get in touch.